China's large-scale infrastructure building projects in African countries such as Angola, Equatorial Guinea, and the Democratic Republic of Congo, DRC, have often been praised as transformative investments. However, beneath the surface lies a complex web of resource extraction deals, elite corruption, and socio-economic challenges that leave local populations questioning the real benefits of these projects. The mechanics of China's deals. China's approach to African development relies heavily on resource for infrastructure agreements, where loans or financing are provided for critical infrastructure projects in exchange for access to the host country's natural resources. These resources, be it oil, minerals, or metals, serve as collateral for the debt. For instance, in Angola, China initiated the well-known Oil for Loans agreement, where crude oil revenues were tied directly to loan repayments. This bypassed traditional financial institutions like the IMF, offering faster financing but often with terms that were less favorable to the borrowing country. Chinese contractors and state-owned enterprises dominate the construction process in these projects. Materials and skilled labor are frequently imported from China, limiting the economic spillover effects and reducing local job creation. The infrastructure built, whether roads, bridges, or government buildings, might not align with the country's actual long-term development needs. Instead, these projects prioritize strategic interests that benefit China, such as ensuring unimpeded access to vital raw materials or extending geopolitical influence. In Africa, in dealings with China, one of the most insidious aspects of these arrangements is the way they empower ruling elites or create shadow governments that manage the flow of resource revenues. These secondary structures often allow leaders and their inner circles to control the vast sums of money flowing in from the Chinese deals. Instead of reinvesting the proceeds into national development such as healthcare, education, or local business development, much of this wealth is siphoned off into offshore accounts. Corruption becomes systemic in countries with weak governance. In Angola, for example, despite massive Chinese investments in post-Civil War reconstruction, poverty remains widespread with little evidence of trickle-down benefits from the country's vast oil wealth. Similarly, in Equatorial Guinea, billions of dollars in resource earnings have been diverted to private accounts, leaving public infrastructure and basic services underdeveloped. This creates a vicious cycle where the population remains dependent on external aid or resources, while the elite amass fortunes that are hidden outside the country. For these elites, China's willingness to engage in opaque deals is a boon, allowing them to bypass accountability and transparency requirements often enforced by Western institutions. China's investment practices also bring significant environmental and social consequences, particularly in resource-rich countries like the DRC. The DRC is home to some of the world's largest deposits of cobalt and copper, essential for modern technologies like batteries and electronics. Chinese companies have secured extensive mining rights in the region through infrastructure deals. The benefits have been marred by reports of labor abuses and environmental degradation. Workers in Chinese-operated mines often face poor working conditions, low wages, and a lack of safety regulations. Additionally, local communities rarely see the profits from resource extraction reinvested into their infrastructure or livelihoods. Instead, they bear the brunt of environmental damage caused by unregulated mining practices. This includes deforestation, water pollution, and habitat destruction. The reliance on natural resources as collateral for Chinese loans creates a dangerous dependency for African nations. When commodity prices fall or resource production declines, countries struggle to meet repayment obligations, risking default. In such scenarios, China has been known to renegotiate terms to its advantage, sometimes acquiring equity stakes in critical industries or infrastructure. This raises concerns about neo-colonial dynamics, where African countries lose sovereignty over their resources and economic policies. For instance, critics of China's dealings in Angola point to the disproportionate benefits accrued by Chinese firms and the Angolan elite. Despite being one of Africa's largest ore producers, Angola continues to grapple with extreme poverty, high unemployment, and limited diversification of its economy. Infrastructure projects have delivered some visible results, but the overall development impact has been muted. While Chinese investments have undoubtedly improved infrastructure in parts of Africa, the hidden costs are significant. The lack of transparency in resource deals, the creation of secondary power structures, and the limited reinvestment of wealth into local economies perpetuate a cycle of dependency and inequality. For China, these projects offer strategic advantages, securing access to vital raw materials, expanding geopolitical influence, and demonstrating its ability to operate outside the Western-dominated financial system. For African countries, however, the challenge is ensuring that these investments contribute to sustainable development rather than deepening debt and dependency. China's involvement in Africa represents a double-edged sword. The infrastructure it builds can be transformative, but the underlying terms of its deals often serve its own strategic interests at the expense of the local population. Breaking this cycle requires stronger governance, greater transparency, and a commitment to ensuring that resource wealth benefits the many, not the few. Only then can these nations truly capitalize on their natural resources to build a brighter future for their citizens.